going to Starbucks. Let's go to the option chain. We're going to puts only. And I am in the small chain, but it gives me various strikes. Let's go out to next week. And I'm going to check the hold button here before we look at any numbers, Hondo. I'm going to go out 3 weeks out in time. 21 days to expiration. That's not standard expiration, but maybe I should use the standard debate. Now, I'm not. I'm going to use this. 7 days remaining to expiration, 21 days remaining to expiration, about 3 times. Let's go out to 60. All right, February, 77 days. All right. Starbucks is trading at 99.20. Let's call the ATM strike the 99. 99 strike for 1 week out, 7 days. Is it, we just use the midpoint for all of them. Let's just be fair and quick. 81 cents. We're going to ignore delta. We're going to ignore probability. The implied volatility range is really low, and that's something that we're going to talk about at the very end. So I like that. It's only 5% of its total implied volatility range. That's important because you're not going to be affected potentially by an implied volatility crush. 21 days out in time, it's priced at 141. Same strike, 99, but now we're 21 days out in time in 7. So our 1 week out is 81 cents. 3 times the amount of time to 21 days would be $2.43. We're only at 141. We're not 3 times the cost. We have a lower cost per day for this position. Are you paying more? Where if Starbucks drops another 5 points on the position, you'd see in 2 days, let's say it drops another 6 or 8 points on Tuesday. Would you have a higher percentage return on the 1 week out option? Yes. But if that movement doesn't occur or doesn't start to occur, it just waffles around 99 or so and 98 for the next 4 or 5 days, and then come Friday it starts to drop, this might still only be worth 10 or 15 cents, depending on where the drop is. It goes down to, 98.90, 98.75, or if it drops down to 96, you didn't close and it comes back up to 98.50, you're only going to have 50 cents here. You're still losing about 30, 35%. Am I saying this one would retain more of its value? A little bit, yes. But what I'm also saying is that drop occurs in the following week. The Monday and Tuesday following, starting off the, not the 9th and the 10th, I apologize, the 11th and the 12th, now it goes back down to 96, 94, or 93. Well, you would have had to buy another one at 81 cents, so your cost basis would now be at 162, 163. I had a cheaper cost buying 3 weeks out in time. And if it still didn't move that second week and I had to buy the other one for this 22nd expiration, there I am at a cost at a 243, where it would have just cost me 141 to begin with. Same concept, 3 times the amount out in time. We've got our 99 put here at 141 for 21 days out in time. A little bit more than 3 times the cost. We don't have a 99, we've got a 100. But the same thing. 3 times the cost, that's close though. 3 times the cost here would put us at what? It'd put us at about 420. And here it's at 405. So bad example, but it's really about 3.3, 3.4 times the amount of time. But the same concept that you hear about when selling options, that you want to sell week by week, every 2 weeks out, or month by month to get the better annualized return, you typically want to be buying 2, 3 to 4 months out time to have the lower cost per day and also have more time for the stock to move in your desired direction when speculating with long call positions or long put positions as well. All right, now, how far it's expiration? In general, as you saw in our defaults, let's just go back there, we're looking about 75 to 150 days out in time. 2.5 months, 3 months out in time to start with. There's nothing wrong with buying leaps if you're expecting more of a pronounced down market. It's going to cost more, but you also have more time for the stock to move in your direction, manipulate the put option without the fear of time value decay so much. What I mean by that, let's talk about the time value decay. I buy that 1 week out option. Let's just go to calculators from the chain. We're going to go to Black-Scholes. And what do we see here? Well, we expect come Monday, we're going to see some time decay on this put. If we bought this put today towards the close, paid our 81 cents for this put, the expectation on 1203 when the market opens, it's going to be at 66 cents if the stock's trading at the same price. Well, that's significant from the 81 cents we paid, right? And we're down not quite 20 cents. We're down about 15 cents, but that's a significant percentage. The stock wavers in this 99 range. Come Tuesday, the expectations were down to 60 cents. We lost about a third. We're down 33% because it hasn't shown the movement yet. Then come the next day, we're down to 50. Okay, that's good. But going into the 6th, going into Wednesday, we're down to 40 cents. We're at a 50% loss if we haven't seen the movement, if the market's just wavering in this time frame. So let me write this down. 1 week out, 12-1 to 12-6. If we got in this position today, come Wednesday the 6th, I believe it's Wednesday, we would have been down 50% on that 1 week out option, assuming the market just waffled and Starbucks stayed around 99. That's a 50% loss. Let's go to that 3 week out 99 strike. Go to Black-Scholes. Yes, this is a theoretical pricing model, Hondo, but it gives you a gauge. Yeah, we would have paid 140 for it. Come Monday, it's only down about 15 cents. Okay, well, so was the other one. It was down about 15 cents, but 15 cents of 80 is a much higher percentage than 15 cents of $1.41. I know you know that, but again, now going into 12-7, the bid's at about 117. We're only down about 23 cents, theoretically, 24 cents. Doesn't show me the 6th directly, but here, even on the 7th, we're only down 24 cents. On that 1 week out put, the market's still waffling by Wednesday, and even by Wednesday on 12-6, it's going to be at 121. So we're only down about 20 cents. We were down 40 cents on the weekly, or 50% of that 81 cent cost. Here on 12-6, we're only down about 19 cents, 20 cents from what we paid into the position. The time decay is slower. It happens more rapidly. And I have more time. Even if it doesn't happen in that first week, yeah, now I'm starting to get down to 40 cents. About a 25% decline of my 140 cost, bid of 105. But I still have another full week, 10 days, for the stock to show me the continued downtrend I was looking for based on the metrics, technicals, and fundamentals I was researching. Now, going back again, let's use the long one. Let's use the 100 strike. We have to because it's not a weekly yet. I got to go to calculators and Black-Scholes one more time. We're going to pay a massive amount of this. We're talking about 410 roughly for this position. I think it was the 405 was the bid. And around 12.6, okay, we lost about maybe 27 cents. 30 cents roughly, down to 373. And then we keep going, and at 12.10, where there are other option would have expired worthless, the first 1 week out option, if we didn't see the movement we want, we're down to 363 from 405 purchase. Time value decay is only about 10%, where we were at already near full loss for the 1 week out, but we were looking at a 25 to 30% loss for the 3 week out when it had dropped down from the cost basis of 141 down to about 105 105, I think it was. We were looking at it that way. That rapid decay happens at the end. So if you buy cheap and you buy short term, you get what you pay for. You're going to see the rapid decay. Go a couple weeks out, hey, you still might be okay for a little bit, but you still got that right around the corner, that rapid decay. 60 days out, 50, 70 days out, you've got the slower time decay working against you. Got more time for the stock to move in your desired direction. Not day trading. We don't try to day trade options. Okay, so maybe yes, we've talked about it and we've showcased some 0 days to expiration spreads, and we've got presentations on that as well. But again, we're not really trying to day trade these positions and try to see, hey, I want a 35, 45, 50% profit on my puts, and I'm going to do that every day. That's really difficult to do. And usually by the time the market opens and you see the trend downwards and you try to buy that put, doesn't really extend necessarily that much. The movement has already happened, or the big movement has already happened. Give yourself more time. Don't try to hit the home run every morning at 9:30 and 01 seconds. Give yourself the time, as you mentioned, for going into a bear market or going into a downfall using the metrics that we talked about.